Starting with RBC a couple of weeks ago, many of the big banks have started to call on the government to do something about Canada's real estate market, saying that the upward pressure on prices isn't good for our overall economy. Recognizing the skyrocketing prices of Canada's real estate market, all of the big banks have made comments on whether or not the government should step in over the next couple of weeks. All five banks have made statements, some offering solutions and some asking the government to step in. And the government's obviously taken notice. It was announced yesterday that they're going to start to study raising the qualifying rate on qualifying for a mortgage. Right now, the rate stands at 4.79, but they're starting to study whether or not it's time to raise it. So clearly, the government of Canada is starting to take notice, and the banks are right on board. So during this video, we're going to do a quick review over which banks have said what, which ones want the government to step in, and what are some of the solutions being provided by the banks. And then finally, we'll conclude by looking at some of the solutions offered and see if any of them might work. So RBC made headlines and not very many friends a few weeks ago when one of their senior economists, and we talked about this in a few videos ago, one of their senior economists actually called for an end to the exemption on capital gains tax for your principal residence. This made a lot of homeowners obviously quite angry, as your principal residence has always been considered a sacred cow in Canada, and that if you sold it, you got to keep all of the profits. So RBC didn't make a whole lot of friends when they suggested this. With that said, RBC suggested that nothing should be on the table to cool down Canada's real estate market, and that the government really does need to step in very fast. So RBC, we can put them on the list of banks that want the government to step in and do something to cool the market. The Bank of Montreal, BMO, is another bank that wants the government to move very quickly to cool Canada's real estate market. On April 7th, it called for immediate action to slow down the price growth of Canada's real estate and offers a number of options on its website to actually cool down Canada's real estate. There are a number of options being floated by Bank of Montreal. Although they don't give a specific preference for one or the other, a look on their website, you can kind of see what they're proposing. First and foremost, BMO has listed on its website the possibility of removing the Principal Residence Exemption from the capital gains taxes. Although they didn't come out in the same manner that RBC did and announce it as something that should be considered, it is put forward as an option. Now, if we look at BMO's website, we can see that although they're not specifically calling for one of these options, it does have it listed which one of these options will have the most immediate effect and which ones are the easiest to put through. The capital gains tax exemption would have the most immediate effects, but BMO, avoiding the negative headlines of RBC, hasn't said anything about it. Funny thing is that BMO is very careful to say that it doesn't have a preference, just that these are options that we could look at. With the capital gains tax exemption being one that would have the most immediate effect, but they're not announcing a preference for one method or another to cool the real estate market. Is it possible that they want to avoid the negative headlines that RBC got? I wouldn't be surprised. They are calling for immediate action. And this would be an immediate action with immediate consequences. So although they're not doing it in a press release, we can kind of see that they're alluding to much of the same suggestions as RBC came out with. BMO's talking about tightening mortgage standards, which, as we already mentioned, the government's already looking at that, and as we've said in a few other videos, raising the stress test could very well be one of the options that the government pursues. So one of the things that they want to do is to end the real estate bidding process, or at the very least, reform it so that you would know what the other bids are when you're submitting your offer to purchase your home. What this would do would be to stop people from way overbidding on a house, far more than all the other offers that have been submitted, in the hopes of securing that house for their purchase. So it would make the process much more transparent and open for home buyers. The idea would be that right now so many bids are going in to purchase houses, and some of them are going sky high, which we've talked about before, in the $100,000, $200,000 range. And by making the bids open and transparent, people wouldn't be so enticed to put in bids so high for a house. When you put in bids that high, it really drives the prices up. Another option that BMO is talking about is starting to more heavily tax, more heavily regulate speculation. Now, when you see speculation, what they mean is people looking to flip properties. So when you buy a house in January, do some minor renovations, flip it and sell it in April, well, they want to have a higher tax on that practice. Scotiabank. So, as opposed to RBC and the Bank of Montreal, Scotiabank came out on April 5th and wants the government to stay out of the real estate market for the time being. They see the real estate boom as a natural consequence of a lack of supply, which should fix itself over the next couple of months as more sellers enter the spring market. What they see is as supply goes up, prices will go down. Scotiabank's report actually says as a headline, there is no urgency to do anything about the housing market. With that said, they have said that if supply does not go up and prices do not go down, then the government should intervene. Unlike RBC and Bank of Montreal, Scotiabank does not want to see an end to the exemption on your principal residence. What they would like to see is speculative, like we talked about before, speculative investment, more heavily regulated, maybe more heavily taxed, which would help to stop the house flippers from gaining such a high market share. Which their idea is that would help bring down demand. So unlike RBC and Bank of Montreal, Scotiabank doesn't want to see an end to the principal residence tax. Rather, they would prefer to see that more is done to regulate speculation by introducing new regulations or new taxes in a bid to try to stop the flippers from driving the market up so high. So on to TD. TD's taken a bit more of a lax and a wait-and-see approach than the previous three banks, saying that the housing market is largely a result of the pandemic, and as the pandemic gets better, as the pandemic and its effects start to recede over the next coming months, that it's likely that real estate will go back down to normal, or at least stop shooting up the way that it has been. TD sees Canada's real estate boom largely as driven by special circumstances that result from the pandemic, with people being able to work from home, with people wanting bigger houses, a bit more space at home, and TD sees it that once the pandemic is finished, that everything should go back to normal, and this sort of weird market that we've been in will stop and go back to the normal laws of supply and demand. Finally, we have CIBC. CIBC is one of the latest ones to comment on Canada's real estate market, and has offered basically one solution, which is to increase supply. They do want the government to step in to increase supply, but that's really the main policy proposal that CIBC is offering. During an interview, Benjamin Towle, which is one of the economists at CIBC, stated that, especially in Toronto, if you think condo prices are bad now, just wait until we get back into the normal swing of things. In fact, Benjamin Towle went on to say that if you think Toronto is bad now, it's much more likely to become like cities like Berlin and London, England, and that our kids are going to struggle to be able to afford homes if we don't do something about the housing supply. So to recap, RBC and the Bank of Montreal both want something done almost immediately, and both have at least tongue-in-cheek or outright said that they want to have the principal residence tax exemption revoked and subject to taxation that we see with other capital gains taxes and on investment properties and such. Meanwhile, Scotia, TD, and CIBC are all taking sort of a wait-and-see approach with various policy proposals in between. So, out of all the proposals that we've seen, which ones are the ones the most likely to have an effect? There seems to be a lot of agreement amongst the big five banks of a speculation tax, or more regulation on speculation. That could definitely work. If we were to take the house flippers out of the market, those that aren't buying houses simply to live in, but rather to earn a profit on, if you take those out of the market, then that could help to decrease Canada's real estate prices. As for the principal residence tax, I think we can kind of see how politically unviable it is by the way that BMO, the Bank of Montreal, is dancing around it compared in response to the backlash that RBC received when it even brought it up 2 weeks ago. The CEO of TD actually commented last week that removing the principal residence exemption is so politically unviable that it's not even worth talking about. So whether or not that would work, we don't know, but it's very, very unlikely that the government's going to introduce that. A lot of the banks definitely do seem to concur that changing the qualifying standards and looking at the interest rates, or the interest rates used to qualify, not the Bank of Canada rate, could definitely go a long way in help making it more difficult for people to qualify for these high mortgages that we've seen in Canada's booming real estate market. So that could definitely work. That's a possibility, and probably wouldn't be too politically difficult, given that at least 1/5 of the country wants to see housing market go down substantially. Finally, and this one was pretty easy, all of the banks seem to agree that increasing the supply would help lower the prices. I mean, if it was that easy, then you would think it would be done by now, but obviously it isn't. Now, most of the time, I talk directly about London and London's markets and London's mortgage rates and how London's real estate market is doing. But with the federal budget set to be released on April 19th, Canada isn't going to come out with a policy just for London. They're going to come out with a policy that's aimed primarily to cool the real estate markets in Canada's largest cities. Really, that means Toronto, Vancouver, and Ottawa. Really, that means Toronto. And Toronto does have a direct effect on London. But I thought it was worth going through just to summarize what the top five banks are saying and what kind of policy proposals are out there. I think most people a month ago would have thought that a big bank coming out in support of eliminating the exemption to your principal residence for capital gains taxes. 3-4 weeks ago, people would have thought, no, a big bank will never do that. And yet we see it with RBC, and then we kind of see a wink and a smile from Bank of Montreal as well. So these are definitely different times that we're living in. And I think it's worth it to note which banks are saying what. And we do know that the Canadian government does pay attention to what the big five banks are saying. And they do incorporate that into their policies. At least their policies are considered. So it's important for us to know what the big banks are saying and what their plans are and how they view the market. The banks are the ones with the money, so it's important to know what they think of everything. If you like this video, please do click like and subscribe, and I will have more updates as the federal budget approaches.